And look where we are today, guys. Very close to another breakout versus SPX for gold. My eyes are right there. They're targeting this.
We're setting a bit of a historic precedent here.
Was it really that event that caused the rally to go up?
The economy is going to start suffering pains.
That's going to be bonkers.
Hey everybody, and thanks for joining us at Talking Trades. It's Kevin Wadsworth and Patrick Karim from Northstar Badcharts.com. And what we're talking about today is what happens when gold breaks out versus the S&P 500. It sends a signal, and it's telling us something that we need to sit up and pay attention. Patrick, take it away.
All right. Thanks, Kevin. Yes. Okay, guys. Whenever somebody says gold versus SPX or it's a ratio chart, right? So both instruments could be going up together, just one that's outperforming the other. Both instruments could be going down, but one's going down less fast than the other, and it makes that ratio chart move in either directions, right? But using a little bit more in-depth technical analysis, we're able to extract more information from that and establish the probabilities of which instrument is more likely to take a tumble than both of them going up together at the same time. So the best thing I could do right now is just to share my screen and give you some visual support. So first thing, whenever somebody shows you a chart, always look at the top left. What are we talking about here? What is shown to you? So here I have the gold price, XAU USD versus SPX. So it's a ratio chart, numerator on top of the denominator. I have the 3-month candles. So these are quarterly candle closes. I have data going all the way back to 1958, even before. But right now, we're just going to show you the setup to what's happening on this chart and how you can derive important information that could help you be a more informed person. So just notice these. Here I have the 12-quarter period moving average. So that's the 36, pretty much a 36-month moving average. And I have these descending trend lines. And then after that, I have price oscillating around that moving average and then price going up. And notice these circles here, right? Here it happened here, circles, here a little breakout here. But the more important ones are the instigating ones, right? The ones here we had close to 1967 all the way to 1971. Here, the one from 1998 all the way to 2001, 2002. Here's another one here, 2007. Here's another one, 2020. So you're going to say, Patrick, okay, fine. This is a ratio chart. You see the price of gold here breaking out, going upwards versus SPX. How does that help me? Why did you put these circles there? Well, what I'm going to show you is here I overlaid the recession indicator. So all these green overlays, these are US recessions. And look what happens. Gold here breaking out, moving up here against SPX. Bam, recession. Here, another one halfway through the bull market for gold in the 1970s. Look at that. Bam, gold explodes versus SPX, recession. Not all the time. Here we had it a little bit here towards the end of the 1980s, blow off top. So it's the more gold is stretched versus SPX, it's these events don't keep repeating because you're already been in the long, meaningful bull run, right? The most important ones are at the beginning and often halfway flags, halfway through an important move, you'll see it again. Look at the 2000s, guys. Gold starting to break out here versus SPX above that 12-quarter period moving average. Look at that when it explodes. Outperforming SPX, recession. And I'll come back to a final point just to tell you where SPX is going while this is happening. Here, halfway flag during that important move. Gold breaking out versus SPX. What did we find? We found the 2008 GFC crisis. Here, we had that March Madness, right? Back in 2020 or even before, March Madness or a little bit before. Gold breaks out versus SPX right there. Recession. And look where we are today, guys. Very close to another breakout versus SPX for gold. Close to a bottom, close to a coiled and tight 36-quarter period moving average. My eyes are right there. They're targeting this. But I need to remind you, what happened to SPX when SPX was breaking down or gold breaking out versus SPX right here? The markets topped and took a tumble. They were entering a bear market. What happened here in 2007 when gold broke out versus SPX? It's not just that gold was rocketing upwards alongside SPX. No, the markets had topped and started tumbling over, while gold remaining flat and outperforming, while this ratio just rockets upward. Here, same thing back here in this recession right here. And this is why this time, if this breaks out to the upside, it's possible that the markets will actually be topping and rolling over, creating this ratio going up. Gold, either it holds its ground or it goes down alongside the markets, but it will go down less fast than the markets will go down. Hence, that ratio will go up, guys. And probably we have other indicators that we're looking at, the yield curve uninverting, opening jobs, plummeting. There's a plethora of evidence that are showing you that either we're in a recession right now, it's starting, but it's coming, guys. So whether they officially announce one or not, in hindsight, we'll find out. But a situation like this makes me very wary that if ever this thing breaks out to the upside, then it's not just because gold is going up faster than SPX. It's probably because the SPX has started a new bear market, guys, or severe correction to start with. So I hope this makes sense. I don't know, Kevin, if you had any insights or questions you had about this there.
Well, listen, guys, when this happened, this is the fourth time that this has occurred, okay, in the last 100 years. It happened in 1930. The stock markets fell, what was it, 70, 80%? More than 80%. And gold was pegged at the time, but it was such a forceful event that gold had to be repegged higher in the 1930s, more than once. So it shows the power of the move. In 1970, 71, 72, it happened again. Gold broke out versus the S&P. What happened? Stock market fell 50% in 3 waves. It went down 25% or so, went down 35% or so, and then it finally capitulated with a 50% drop. So it was 3 waves down. Happened again, as he said, in 2000, 2008. People forget, it's not that long ago, and the markets fell 50% twice. 50% in 2000, 50% in the 2008 event. Huge, huge implications, guys. Amazing stuff, Patrick. Thank you very much for that. So don't forget, if you want more content like this, you're enjoying what you're seeing, don't forget to like, subscribe, and hit that notification bell. Bye-bye for now.